Okay, so let's continue on with chapter 2. So we're on what's called T accounts. And T accounts are a good way to look at the general ledger. So as I mentioned earlier in the previous video, there's a general ledger, and the general ledger keeps track of all of the balances in all of the accounts. Okay, so the T account can do the same, it just doesn't have as much information. So let's have a look at what we've got here with the T account. So you can see on the left side of the T account is always called a debit, or DR for an abbreviation. The right side is always called a credit, or CR as an abbreviation. So let's have a look for an example. Okay, so we've got a cash account. Okay, so if you think of the T account as well, the shape of the T account, you've got the left side, and think of the balance sheet. The left side are your assets. And then think of the right side, and the right side is your liabilities and your owner's equity. Okay, so when you look at the individual accounts, so for the cash account, if it's posted on the left side, which is where it appears on your balance sheet, then anything that happens that's going to increase the balance of cash is going to go on the debit side or the left side. So for example, an investment by an owner is increasing your cash, so it goes on the debit or the left side. You received money from providing a food service of $2,200. It goes on the left side or the debit side. And again, it's increasing your cash balance. You collected your accounts receivable for $1,900. Okay. And again, it goes on the positive side of cash, the debit side, the left side, because it's an increase of the amount of cash that you now have. So if you remember, these are the same numbers from the example that we did at the end of chapter 1 when we analyzed all of a bunch of different transactions and how it would affect each of the accounts. Okay, so we also purchased supplies and paid cash for them. So that decreased the cash. So therefore, it's going to be on the credit side or the right-hand side. We paid rent, we paid a salary, we made a payment to accounts payable, and the owner withdrew $600. Those are all decreases to our cash account. So they are going to go on the credit side or the right-hand side of our T account. So then you would add up each side, figure which side has the higher balance. So then we see increases of 14,100. Our total decreases were only 5,700. So if we subtract that, then we know our ending balance in our cash account is $8,400. Okay. So the steps again, you go through, calculate the total increases shown on one side, okay, including the beginning balance. So if there was an opening balance, you'd include that as well. Calculate the total decreases shown on the other side. Subtract the sum of the decreases from the sum of the increases, which we did. We took 14,100 minus 5,700, and then we got our balance of 8,400 on the positive side for cash, which would be the debit or the left-hand side. If you found that a little confusing, feel free to rewind, start the video back at the beginning, and go through it again. That's one of the joys of video. Okay. So debits and credits. So your debits have to equal your credits. And this is what ensures that at the end, when you're creating your financial statements, as long as your debits equal your credits in every transaction throughout the whole cycle of the accounting, then in the end, your balance sheet is going to balance. Okay? So every transaction affects at least two accounts. The total debits must equal the total credits for every transaction, and this is what's considered double entry accounting. It helps to prevent errors by ensuring the debits and the credits for each transaction are equal. So as we saw, for every transaction we did, at least two things happened. Okay? We provided somebody with a service and we got cash. We bought something, we paid cash. Or we bought something and it created an accounts payable. Okay? So there's always at least two things that happen. Okay. So here's a little cheat sheet to help remember um, where things go and how things get affected. And again, it's because the assets equal the liabilities plus the equity. So if an increase for an asset is a debit, then it makes sense that the increase for a liability has to be a credit, or an increase for the equity has to be a credit, because our debits and our credits have to balance. Okay? So if an asset goes up, either another asset is going to come down, which would cause it to balance, right? We bought supplies and gave them cash. Or if an asset goes up, a liability is going to go up. So we bought a truck, so we know that's a debit because it's an increase for our asset. And if we owe a bank loan, we know that our liability is going to be credited because that's how our liabilities increase. And then our debits equal our credits. Okay, so for double entry accounting, It's this is basically exactly what I've just finished saying. Increases in assets are debited to assets accounts. Decreases in assets are credited to asset accounts. This is just the words around the pictures, okay? So you can see here, assets, an increase is a debit, decrease is a credit. For liabilities, an increase is a credit, a decrease is a debit. And for equity, increases are credits and decreases are debits. And it's just saying here that for asset accounts, debits mean an increase and credits mean a decrease. For liability and equity accounts, debits mean a decrease and credits mean an increase. Do not assume the terms debit and credit means increase or decrease. It depends on the account. Here you can see how all of the debits and credits affects for all of the different accounts. So for example, assets, we know an increase in an asset is a debit, a decrease in an asset is a credit. For liability, an increase is a credit, a decrease is a debit. For the owner's capital account, an increase is a credit, a decrease is a debit. For withdrawals, if we remember, withdraw reduces equity. So if you withdraw more, that's going to be a debit. Revenue is going to be a credit, and we'll never use debits for revenue. And then for expenses, expenses are debits because they reduce our equity. And sometimes when you're doing a transaction, if you can figure out what one side is, say you're involved with revenue and cash, if you know that cash has gone up and that's a debit, then you can determine that because revenue has gone up, it's a credit, and then your debits and your credits balance. So the normal account balances for an increase, if you're increasing an asset, it's a debit. If you're increasing a withdrawal, it's a debit. If you're increasing your expenses, they're debits. For credits, if you're increasing your liabilities, it's a credit. If you're increasing your owner's capital, which would be an investment, that's going to be a credit. And revenue is also going to be a credit. So chart of accounts. So when we start recording, um, we have numbers, okay? So we're going to start numbering our accounts. And this is the standard layout for our chart of accounts. Any asset accounts are 101 to 199. Liabilities are the 200s. Owner's capital and withdrawals 300s. Revenue is in the 400s. Cost of sale expenses are in the 500s and other expenses are in the 600s. And it's just easier, and especially in the world of technology now, once you move on to computerized accounting, you will see that everything is done by account numbers. Okay, so this is just to start getting you used to numbering your accounts. Hope this helps. Let me know if you have any questions. Thanks, everyone.